All right, today we're tackling a pretty big idea, something that might even sound a little backwards at first: the white collar winter. We're going to look at how these massive AI driven layoffs you're seeing in the news aren't just about efficiency. They're creating a very specific kind of risk and, believe it or not, a huge opportunity in the bond market if you know where to look. And this quote right here, it cuts straight to the chase. That safe 60/40 portfolio, the one that's the backbone of so many retirement accounts, is totally exposed to what's happening. We're talking about a fundamental shift where AI is creating this weird, stagflationary environment that could put those standard retirement plans in some serious jeopardy. Okay, let's dive into this. To really get why this is so dangerous, you first have to understand the story Wall Street is telling itself. It's all about efficiency, and it's a story that has been making investors a lot of money. So for the last couple of years, the market's been running on this, let's call it a cold calculus. The logic is pretty simple, right? On one hand, you've got expensive human labor. That's a cost that always seems to go up. On the other, you have AI compute power, a capital cost that just gets more powerful and cheaper every year. The market sees companies swapping people for silicon and thinks, wow, that's a smart trade. That's going to boost profit margins. In this table, man, it shows you exactly how that played out. Just look at how the market reacted. Salesforce announces layoffs, boom, the stock jumps 27%. Meta does it, and they're up almost 25%. The story was clear. Investors loved this year of efficiency. But then, look at Amazon. They do something similar, and the stock drops almost 19%. So what gives? It all came down to the story. The market saw Amazon's move as a sign of weakness, not a genius pivot to AI. It just goes to show you how powerful the narrative is. So yeah, the market has its playbook, and it seems to be working, right? But what if that playbook is based on a map of the economy that's completely out of date? This next part, well, it introduces one single piece of data that suggests the entire game has changed. And that really is the crucial question. For decades, the rule of thumb was simple. When a company grew, it hired more people. That basic idea is baked into almost every financial model out there, including the one that's probably managing your 401k. But what happens if that fundamental rule is just broken? And here it is, the big one, negative 400,000. For the first time in almost 10 years, the S&P 500, we're talking the 500 biggest companies in the country, as a group, employed fewer people. This isn't just one or two companies having a bad quarter. This is a systemic shrinking of the professional workforce, and it's happening while the stock market is hitting all-time highs. That is the disconnect we need to talk about. This chart just makes that disconnect painfully obvious. Look at that bar on the right. A huge, nearly 18% return for the S&P 500. Profits are through the roof. Now look at the bar on the left. Headcount is down 1.4%. This isn't some soft landing. This is a total decoupling of Wall Street's success from Main Street's. So here's the bottom line. We're seeing a structural fracture in the economy. AI isn't just helping people do their jobs anymore. For a lot of white-collar roles, it's starting to replace them. This creates a situation where stocks can go up without new jobs being created, but at the same time, it eats away at the very customer base those companies need to survive. And that, my friends, is a really dangerous feedback loop. So that brings us to the mechanics of it all. I mean, how can these companies look so incredibly profitable while the foundation of the economy is getting weaker? Well, the answer has to do with something called a liquidity trap, and it's being supercharged by some clever financial engineering. So what on earth is a liquidity trap? Think of the economy like your body's circulatory system. Money is the blood. It's supposed to flow from companies to workers as salaries, and then from workers back to companies when they buy things. But in a liquidity trap, that flow just stops. The money pools at the top, inside these massive tech companies. They have so much cash they literally don't know what to do with it, so they start using financial tricks like stock buybacks just to keep the share price going up. And this slide just lays it out perfectly. On the left, you've got the textbook definition you learn in business school. Buybacks are just a way to return cash to shareholders, no big deal. But on the right, you have the reality of 2026, what some have called sinister. Buybacks become a weapon to hide slowing growth. You can cut thousands of jobs, watch your sales flatline, but by buying back your own stock, you can artificially juice your earnings per share and make it look like you're crushing it. And Meta is the perfect example here. In April 2026, with its stock at an all-time high, the company says it's getting rid of 10% of its people. Now, this wasn't some move they made because they were in trouble. It was a strategic choice to trade their labor bill for a bigger AI server bill.
And here's the brutal truth. History is really, really clear about this. When a company at its peak valuation announces a huge layoff like that, it is a massive red flag. It's basically management telling you they think real organic growth is over. And historically, a move like that is followed by a big correction in the stock price, about 15% over the next 18 months. They're not signaling strength, they're signaling the top.
Okay, so if the stock market is actually way riskier than it looks, where do you go? Where do you find safety? Or even an opportunity? This brings us to the core idea of this whole explainer, a defensive move into a very specific kind of investment. We're calling it the white-collar bond play. So how does this trade actually work? Let's walk through it. Step 1, the cause. AI leads to a lot of white-collar layoffs. Step 2, the effect. All those professionals who just lost their jobs stop spending money on things they don't absolutely need. That hits consumer companies hard. Step 3, the anomaly. The same tech giants doing the layoffs are still loaded with cash and are selling bonds to pay for all their new AI toys. And that brings us to step 4, the play. You buy the high-quality bonds of these strong tech companies, and you bet against the stocks of the consumer companies that are losing their best customers. And this table kind of breaks down the whole strategy by sector. See, in this kind of market, you have to be really picky. We're bearish, meaning pessimistic, on consumer discretionary. That's the short side of our trade. We're also bearish on utilities, because they're taking on tons of debt to build power plants for all this AI. For technology, the outlook is neutral, but that's where the opportunity is. They're going to be selling so many new bonds that the sheer supply will probably make them a little cheaper to buy. You're basically getting paid a little extra to lend them money. You're betting on their ability to pay their bills, not on their stock going to the moon. So why does any of this matter to you? This final section brings this whole huge macroeconomic trend right back to your retirement account. Because that traditional safe 60-40 portfolio is built on a set of rules that might be dangerously wrong today. This is so important to understand. If you own a basic S&P 500 index fund, you probably think you're pretty diversified. But look at this chart. The reality is, nearly a third of your money is in just 7 tech stocks. Your retirement isn't really a bet on the whole US economy. It's a highly concentrated bet that a handful of companies can fire their highest paying customers and somehow still grow forever. And you're making this bet while being squeezed in a stagflationary vice. On one side, you've got inflation that just won't go away, driven by things like massive energy demand for all that AI. On the other side, the high-income job market is getting weaker. That combination is absolutely toxic for a 60-40 portfolio because it breaks the #1 rule. Bonds are supposed to save you when stocks go down. In this environment, they can both fall at the exact same time. Let's just be crystal clear about the risk here. That 60% of your portfolio in stocks, the part that's supposed to be your growth engine, is making one giant unspoken bet. It's a bet that this AI revolution can completely replace the professional class without destroying the very people who buy everything. And from what we've seen today, that feels like a pretty darn risky bet to be making. And that leaves us with the one giant, lingering question of this whole AI era. It's the ultimate paradox. Are we so obsessed with making things efficiently that we're forgetting about who's supposed to buy them? Is AI building a world that is incredibly profitable for a tiny few, but has basically priced everyone else out of the market? That's the real question to think about as this white-collar winter keeps getting colder.